Accenture, the world's largest IT services and consulting firm. Overall verdict: yellow. Dubai. Accenture operates across 5 divisions: strategy and consulting, technology, operations, Song, its creative marketing arm, and Industry X for engineering. The firm serves 49 industries in 120 countries, with 801,000 employees. Global delivery centers in India, the Philippines, and Eastern Europe provide a structural 30 to 40% labor cost advantage over boutique competitors. CEO Julie Sweet has led Accenture since October 2019, committing $3 billion to AI upskilling and launching the Total Enterprise Reinvention Strategy in 2023. Revenue has compounded at 8.3% annually to $69.7 billion. Free cash flow is growing faster than earnings, 10.3% valuation. Accenture trades at 9.5 times EV to free cash flow. FCF yield of 10.5%. Zero growth intrinsic value test. If Accenture's free cash flow never grew again, the perpetuity value at a 10% discount rate is approximately $112.8 billion, or $183 per share. The current price of $174 is below the zero growth intrinsic value. The market is pricing in permanent free cash flow contraction or severe AI-driven disruption. Neither has materialized in 7 years of data. Base case DCF at 5% FCF growth and a 10% discount rate produces 4 numbers define Accenture. Return on invested capital, 17% in FY 2025. Down from 26% in 2019, but still well above the 10% cost of capital threshold for all 7 years. Revenue has compounded at 8.3% annually, reaching $69.7 billion. Net margin, 11%, stable across 2 full economic cycles. Free cash flow, $10.87 billion in Phase 1 forensic screen, 8 signals, 3 flags. Revenue grew 61% over 7 years. Net income also grew 61%. Net margin oscillates in a tight 10.7 to 11.7% band across all 7 years. No engineered margin compression or expansion. Clean. Free cash flow exceeds net income in all 7 years. FCF to net income ratio never below 1.26. Asset-light professional services confirms the model. CapEx is well below depreciation and amortization every year, classic asset-light profile. The D&A spike in FY 2025 reflects acquired intangible amortization from elevated M&A, not capitalized operating costs. The first yellow flag, DSO crept from 68 to 79 days, an 11-day increase over 7 years. The OCF to NI crosscheck clears this, 1.49 in FY 2025. Cash conversion is intact. Rising DSO likely reflects mix shift to larger enterprise contracts with longer payment cycles. Monitor. The second yellow, FY 2023 other expenses of $1.06 billion. This corresponds to Accenture's disclosed Phase 2 financial analysis. Revenue grew from $43.2 billion in 2019 to $69.7 billion in 2025. A compound annual growth rate of 8.3%. 3 drivers. First, organic volume. Demand for IT transformation and managed services grew through both cycles. Second, acquisitions. 40 to 50 tuck-in deals per year added capabilities and revenue. Third, pricing. Accenture commands a 15 to 25% premium over offshore peers. FY 2024 was the only soft year. Revenue grew just 1.2%. Corporate discretionary consulting budgets were the first to be cut in the rate shock environment. FY 2025 recovery margins tell the operating leverage story, or in Accenture's case, the absence of it. Gross margin improved from 30.8% to 31.9%, a 1.1 percentage point gain. Operating margin moved from 14.6% to 14.7%, essentially flat. SG&A grew from 7 billion to 11.4 billion, 63%, tracking revenue exactly. For a company at this scale with 8% revenue CAGR over 7 years, operating leverage should be more visible. The structural explanation: Accenture's cost base is people. As revenue grows through acquisitions, DuPont decomposition shows the quality of Accenture's return profile. Return on equity fell from 33.2% in 2019 to 24.6% in 2025. Which lever caused this? Asset turnover. Asset turnover compressed from 1.45 to 1.07. The denominator grew faster than revenue. Net margin is flat, 11.1% to 11.0% across 7 years. Financial leverage is stable, 2.07 to 2.10. Diagnosis: the acquisition program is growing the asset base through goodwill faster than revenue. Not operational deterioration, not margin compression, not leverage engineering. Pure denominator expansion from a serial acquisition strategy. Net margin stability. Phase 3 moat assessment. 8 of 9 filters pass. Accenture's moat is narrow, driven by switching costs and scale economies. Switching costs are the primary structural barrier. Enterprise clients embed Accenture consultants and tools deeply into transformation programs, ERP implementations, and managed operations. Switching involves financial costs, contract exit penalties and knowledge transfer, procedural costs, re-onboarding a new team to proprietary systems, and relational costs, senior client relationships built over years. Renewal rates for managed services clients are estimated at 90% or higher. A Fortune 500 company mid-digital transformation does not change its system integrator partner without multi-year disruption. Scale economies are the second power. 800 and 1,000 employees enable global delivery centers with 30 to 40% labor cost advantage over boutique competitors. Scale also enables bidding on 500 million plus mega deals that mid-tier firms cannot staff. The narrow rather than wide classification reflects 2 structural limits. First, consulting moats are people-dependent and partially portable. Second, AI represents a genuine counter-positioning threat. If AI age. Phase 4 capital allocation. Accenture has returned 76% of free cash flow to shareholders over 7 years, 45.3 billion total. 26.9 billion in buybacks, dividends paid consistently. 2 yellow signals drag the verdict. First, buybacks in FY 2021 and FY 2022. 7.8 billion at $280 to $400 per share. That was 24 to 25 times EV to free cash flow, well above intrinsic value. Second, the acquisition treadmill. 40 to 50 deals per year has inflated goodwill from 6.2 billion to 22.5 billion, 72% of equity. The serial acquisitor pattern is difficult to verify on a per-deal basis. 2 positives: debt use is conservative, and current buybacks at 174, 9.5 times EV to free cash flow, are the most value-accretive in company history. Phase 5 competitive dynamics. Accenture is in the stability stage, a company whose scale and switching cost powers were built during IT consulting's takeoff period. 2 confirmed powers. Scale economies. The global delivery center model delivers 30 to 40% labor cost advantage over boutiques. Only Accenture can staff 500 million plus global transformation deals. Switching costs. Financial, procedural, and relational barriers are embedded in multi-year engagements. Managed services renewal rates are estimated at 90% or above. Partial credit for branding. A 15 to 25% pricing premium over offshore peers for C-suite transformation mandates. But this is institutional business-to-business branding, a weaker form than consumer hysteresis. The AI risk gets the correct strategic frame, counter-positioning. AI-native consulting firms can build a better model that Accenture cannot fully replicate without cannibalizing its own headcount-based revenue. If successful adaptation, switching costs deepen and economics improve. If unsuccessful, overall verdict yellow buy. Accenture passes forensics cleanly. The moat is real, switching costs and scale confirmed by 17 to 26% ROIC above WACC for all 7 years. The financial profile shows revenue, EPS, and FCF compounding at 8 to 10% CAGR, with stable 11% net margins. The yellow flags are structural, ROIC declining as the acquisition treadmill inflates goodwill, and SBC largely offsetting buyback value creation. But the valuation case is the strongest element. EV to free cash flow of 9.5 times against a 7-year FCF CAGR of 10.3% is historically anomalous for a quality compounder. A buyer at current prices is essentially getting the growth for free. The risk to monitor: AI disruption of the labor-intensive delivery model. If Accenture successfully transitions from selling headcount to selling AI-augmented outcomes, the moat may actually. The 10-minute test is a quality gate, not a verdict. 8 of 9 filters pass. Exchange listed, NYSE, regular SEC filer, KPMG auditor, check. Profitable all 7 years. Lowest net income, $4.78 billion in FY 2019, check. Operating cash flow positive all 7 years, growing from 6.6 to 11.5 billion, check. Return on equity above 10% in all 7 years, range 24.6 to 33.2%, check. EPS 749, 803, 931, 1087, 1090, 1157, 1229, unbroken upward trend, check. Balance sheet debt to equity 0.24 times, interest earned 45 times, net cash positive 4.1 billion, check. Free cash flow to sales 14 to 16% all 7 years, check. Low charges, 1 restructuring event in 7 years, FY 2023 1.4 billion, 19,000 headcount, yellow not red. Share count 638 million to 625 million, minus 2% in 7 years. 26.9 billion in buybacks, offset by 11. Share count 638 million in 2019, 625 million in 2025, a reduction of only 2% over 7 years. The headline is deceptive. 26.9 billion in buybacks over 7 years, offset by 11.3 billion in stock-based compensation. The buyback program is primarily a dilution offset mechanism, not genuine per-share improvement. Per Outsider's framework, actual per-share value improvement requires the share count to fall, not stay flat. The positive, at current prices of 174, 9.5 times EV to free cash flow. Buybacks are genuine cash deployment audit over 7 years. Total free cash flow, 57.3 billion. Buybacks 26.9 billion, 47% of FCF. Total return to shareholders, 45.3 billion, 76% of FCF. The mechanism concern: SBC of 11.3 billion over 7 years means the buyback program largely offset dilution rather than reduced shares. The total outstanding share count fell only 2%, despite a massive buyback program. Current buybacks at 174, the cheapest the stock has been on EV to FCF in a decade, represent the best use of capital in the program's history. Financial health. Long-term debt grew from near zero in 2019 to 7.34 billion in 2025. Debt to equity 0.24 conservative. Net cash positive 4.1 billion, 11.5 billion cash, exceeds all short-term obligations. Times interest earned 275 times in 2019, declining through the period as debt was issued to fund acquisitions. 45 times in 2025, The decline reflects a $7.3 billion long-term debt issuance for acquisitions. 45 times still means Accenture could lose 97% of EBIT and still service its debt. 3 independent valuation methods. First, cash return. Free cash flow of $10.87 billion against enterprise value of $103.2 billion. Cash return 10.5%. The 10-year Treasury yields 4.3%. Accenture pays a 6.2 percentage point premium over the risk-free rate. For a quality compounder, 2 to 3 points is sufficient. Accenture doubles that. Second, price to sales. Current 1.54 times. Historical range 2.5 to 4 times. The stock has not been this cheap on sales in more than a decade. Third, DCF base case. At 5% FCF growth and a 10% discount rate. Equity value, approximately $188 billion. Per share, $306. Current price, $174. All 3 methods agree, significantly undervalued at current levels.